Tom Leahy, you are Senior Director at Real Capital Analytics. Thank you for joining us on BiTV.
No problem. Thanks for having me.
RCA reported that the volume of European CRE investment transactions in Q2 2020 was the lowest 3-month level since 2014 because of the pandemic. How have the drop in activity and the uncertainty of the recent months impacted valuations and yields on the main European markets?
Yeah, good question. So the pandemic has certainly impacted deal volume and deal flow. So if you look at our transaction volumes for across Europe, deal volume is down about 30% in comparison with this time last year, which is actually a better outturn if you compare Europe with the US market or the Asia Pacific market in terms of total volumes. Deal count is down by more, so that's down by about 40%, again, as a result of the pandemic. So there's been more of the larger deals complete, and the slowdown has been most marked in the smaller transactions. But from a sort of a pricing standpoint, it's still relatively early, I think, to draw very firm conclusions about the effect that the slowdown is having on pricing. I mean, ordinarily you would expect with the nature of this crisis is certainly new for all of us who are currently, working in the real estate market, because it's a health crisis that has fed through into an economic crisis that's then feeding through into what's happening in the real estate market. So it's new in terms of how its effects are feeding through. And it's still relatively early, but I think some of the things you can say is clearly some sectors of the market have been more affected than others. So certainly we're seeing prices for retail assets softening, for hotels as well, more than for, let's say, office assets or for apartments, for example, where actually investment volumes have been really very strong for the apartment sector across Europe. It seems to be a part of the market that is holding up really very well. If you look at our own pricing data, sort of splitting the market down to look at individual cities, because different stories are playing out across the continent. The first movers tend to be the larger, more liquid markets. So our commercial property price indices are showing small downwards movements in prices in central Paris, for example, the central German A cities. For central London, the story is quite different, actually. The market has really been quite slow for a while now, and prices have been softening, in comparison with where we were last year, even before the pandemic started to affect the market. But it's still relatively early days, and when you've got a period of very low deal volumes, there's an issue in a sort of private market like real estate of price discovery. So buyers and sellers tend to move apart from each other. So the deals that are being done have, I think, there is some softening, but not in the same extent that we saw in the global financial crisis, at least not yet anyway. But I think the important point to make is the picture isn't uniform as well, so it varies quite sharply by geography and by sector.
If you look through your crystal ball, which I know is a difficult exercise, but what level of activity do you expect from the European investors this fall, given all that?
Yeah, I mean, we've sort of approached this question in kind of various ways, looking at our own RCA's own database of real estate investment sales. And one thing we can do is we can look at the volume of pending deals in our database, and there's quite a good fit. So there's deals that are in contract, so the property's under offer, but the deal hasn't completed yet. We can look at the volume of those as a good indicator for where investment might be in the second half of the year. So in the moment, that's suggesting investment in H2 would be around, let's say, between 100 and maybe 130 billion euros in the second half of the year. And so that would leave this year quite a long way down on last year. But that's a relationship that's really, we've looked at that over time, and the relationship does hold between pending volumes and then completed volumes 6 months later. But that's those relationships we're looking at were during a period of normal market activity, and obviously the market's moved into sort of an abnormal phase. And so there's lots of risks to the upside and the downside of that. So on the downside, if we see more lockdowns on a sort of national level, that I think will clearly impact deal making, just for the physical reasons that, you know, property is a physical asset.
We saw in the past.
Yeah, exactly, like we saw in, you know, in April and May. And on the upside, it may be that, you know, while the virus has started, you know, the cases of the virus have grown, but, you know, governments and health authorities are able to manage that. People are able to get back to work a little bit more, and there's plenty of, and on the upside risk, and the other thing to say is there's plenty of capital available. So if the virus outbreaks are contained, if we are getting back to work and people are able to travel around a little bit more, we could see a real acceleration of deal flow in the second half of the year, because interest rates are still low. There's still lots of equity out there that seems to want to access the real estate market. I think the other restriction on deal flow, maybe despite all the equities, actually the parts of the market that people want to invest in are, you know, there's only a finite number of apartments or industrial logistics units, maybe prime city centre offices that people can invest in. You know, retail was always the biggest slice of almost every institution's portfolio historically, and with large parts of that off the market, that leaves a big hole. So it may be that actually, you know, that structural change is also a limit on total activity in the second half of the year.
And and given that maybe increased level of competition on the market, do you see some type of investors, some type of strategies being more active in the coming months?
Yeah, it's a good question. I mean, I guess, you know, if you look at the capital raising stats, most of the money being raised is for sort of value add and opportunistic funds. So that would suggest that those kinds of players will be more active in the market, or at least, you know, they're trying to deploy this capital. I guess the question is, will those opportunities arise? You know, we obviously saw a lot of that coming out of the GFC with the, you know, the formations of the bad banks and all the NPL portfolio transactions happening, and distress, and that was feeding through into very high levels of activity from you know, the US private equity firms, for example. I guess this time around, you know, we're not, you know, we haven't seen the same levels of distress. I wouldn't have said, you know, certainly in the data that we have at RCA. And it seems like, you know, lenders and borrowers are trying to be accommodating, or lenders are trying to be accommodating because of the different nature of the current crisis. But, you know, I'm sure there will be opportunities for those kinds of players in maybe the hotel sector. Might be one part of the market we could see some activity from the sort of value add opportunistic players. You know, possibly parts of the retail sector, but I think prices will probably have to continue to fall to make parts of that market look attractive, especially for things like change of use, which seems to be a natural result for some of these retail centres, especially that are, you know, probably past the end of their useful lifetime in terms of their commercial use as retail centres. So possibly conversions into warehousing space. You know, we've seen a little bit of that in the US, for example. With sort of, so I think some of the JCPenney stores are being converted to use by Amazon into warehousing space, or, you know, for sort of delivery hubs. So we might see some of that. But, you know, there's still a lot of capital out there looking for core investments as well. But clearly prices have been very expensive for that part of the market. You know, core, you know, office yields in core markets are sub 3%. So, you know, if we see a little bit of softening, we might see more activity in that part of the market come back as well.
Okay, great. Well, thank you very much, Tom Leahy, for taking the time to speak with us. And thank you all for following us, and see you soon on BiTV.
Thank you.